Convergence is not more than 30%.
Yeah, even I mean that's what we've also seen.
Yeah, I know.
But I think
We
as
have
you keep
started seeing
doing,
some transactions, Manish.
Is it we have?
Yeah,
Nice. Very
we are
good.
getting some. I think in the month of January only we got 2-3 transactions,
Mhm.
and that was at a good amount. So this is actually working very well. I thought of dropping an email to you and Mansi, but I somehow
And
forgot that.
let's not celebrate too early. Let's wait.
Yeah,
We are in
but
for a
in
long
January
run.
we got people. In February also we have some people who have started.
Okay. So our PR note should be going out soon, right? Papiya, आप कुछ भेजने वाले हो हम लोग को. So that
yes,
should
I
happen.
will send it soon.
And yeah, so we'll talk later on what things we are planning from our end. So we want to make this calculator the big hero, you know. So we'll be doing some integrations on that front on our website. So those things are on the way. Talks are on the way.
Okay, we've
Okay,
started
आपने slide number 12 हटाया है क्या?
Yes, I'm using your slide. We have some attendees already. So let's just wait for 4 minutes and then we'll get started.
Sure. So Neeraj, what I was thinking was, आपको slide number the saving and investment वाली slide है. You do that, and then you just probably ask me for my comments and observations, and then I come back on that. I'll come to that slide, and then I'll start and cover the next 3 slides. Okay.
Sure.
Slides आप change कर रहे हो Papiya, right?
Yes.
Okay.
We will begin in a minute.
Yeah, I think it'll take a couple of minutes.
Yeah. We will start in another minute. I see some people raising hands. We will have a Q&A session once we're done with the presentation. So you can ask your questions in the chat box. So we'll begin, Manish, Neeraj.
Yep.
Welcome everyone to the webinar on smart parenting, how to start with mutual funds. This is in association with DSP Mutual Fund. I would like to start with introducing our guests, speakers. So we have Mr. Neeraj Satnalika, who's the head of research and one of the founding team members at EduFund. Neeraj has a total experience of 8 years across industry research, investment management, mutual funds, and credit rating. Before joining EduFund, Neeraj has worked with brands like Goldman Sachs and CRISIL, and he holds a PhD in finance from IIT Bombay and a PGDM in finance from IMT Ghaziabad. Our second panelist is Mr. Manish Rathi, who is the head of digital B2B at DSP Mutual Fund. He's been with DSP since 2019, and he heads and takes care of digitizing the mutual fund distribution at DSP along via different independent distributors, working with fintechs and other online advisors. He has an experience of about 14 years across digital payments, analytics, mutual funds, and e-commerce in India and abroad. I would like to introduce EduFund to you. We are a startup. We like to call ourselves the initiators of India Chala College movement. So basically, our aim is to help parents plan their finances better to save for their child's college and higher education. We aim at helping every Indian parent afford their child's dream college fees and costs, because that's rising at a really rapid speed. And we want to help them manage their finances and start saving and investing early, so that Indian parents can achieve their and their child's dream. I would also like to introduce DSP mutual funds, although there is no introduction needed. It's one of the leading mutual fund manufacturers in India, and it has been around for more than 2 decades and has been helping investors make their financial decisions better on the basis of honesty and integrity. It's backed by one of the oldest group, DSP groups, and it offers their products and its varieties span across equity, debt, hybrid, international ETFs, and close-ended funds. It's headed by Aditi Kothari as the chairperson and Kalpain Parekh as the MD and CEO. I would like to request Neeraj to take it from here.
Thank you, Papiha. Thank you for joining today's webinar. Good evening, everyone. Today's topic is smart parenting, how to use mutual funds, how to start with mutual fund. Before I invite Manish to talk about mutual fund and SIP, let me show you some numbers. Next slide. Can you guess the cost of education in these some brilliant colleges? Any guesses? Let me show you the numbers. An international degree from Princeton University costs you 1.6 CR, whereas a degree in management from IIM Ahmedabad costs you 23 lakhs. This cost was probably just the half few years ago. So what exactly happened? Well, the increase in the cost of education is because of education inflation. Let us understand what is inflation. Inflation is the change in the price of goods and services which you are consuming in the economy, right? So the upward movement in the overall price is nothing but inflation. India's average inflation is at 6%, but education inflation is at 10%. How do we read that statement? This means that you will take roughly around 7 years, or in the next 7 years, the cost of education is just going to double. So if your child is going to go to college in 15 years from now, the cost of education is going to be 4 times. Can you go to the next slide? So if you see, the 1.6 crores would roughly become 6.4 CR at this pace of inflation. Similarly, for an IIM Ahmedabad, the cost would be almost near to 1 crore. No wonder education is the basic need after roti, kapda, and makan. Now the question arises, how do you plan to accumulate this corpus? Since education is a defined event and is a long-term journey for a parent, investing is the best solution to plan for this corpus. Let us see what is savings via investing. Savings is more like putting money aside in a bank account, which grows at a single digit. But considering the fact that education inflation is growing at 10%, it's important that your money grows faster than that, so that you can actually absorb the rising cost. In this scenario, it is important that you plan for a really long-term horizon for your child's education. And you try to take an exposure to asset classes such as equity, which has in the past beaten inflation with a very fair margin. Let me now invite Manish to share his views on savings via investing and also throw some lights on mutual funds and SIP.
Thank you, Neeraj. Thank you, Team EduFund, for inviting me. So, Neeraj, before I start, I think what you just presented are some mind-boggling numbers. And Papi, if you can just go back one slide, just go to the previous slide. So imagine, I mean, I'm looking at these numbers, 6.4 crore, 1.2 crore, 92 lakhs, IIM Ahmedabad, 5.2 crores. And these are the costs in 15 years. I'm just trying to, go back and consider myself as one of those guys who did my MBA in 2008. I remember I paid some 5 or 6 lakhs at that time. And now today, the cost is so high. And 15 years later, the cost is going to be unbelievable. It's like, aankhein khul jane wali slide, honestly. And I'm sure everybody who's on this panel today, who's on the, the list today, who's listening to it, they'll realize this is actually real. Friend, this is not exaggeration. This is real. I have a 6-year-old daughter, and if I feel that, I want to send her out for a specialization of her own choice, be in engineering, medical, MBA, whatever. And if I have, let's say, if I dare to plan to send her abroad, the costs are going to be unimaginable. So what am I doing today? Am I prepared? That's the biggest question. And this is where investment and saving comes. Let's go back to the usual slides, Papiya. Thank you. And Neeraj, you mentioned a few terms when you spoke about this slide. You mentioned a few terms like saving and investing, right?
Yeah.
As Indians and as normal retail investors, as who we call, like to call ourselves a little more aware investors, we use these terms almost on a daily basis. These are one of the most common investing and common finance terms. But the problem is we use it interchangeably. मुझे सेविंग करना है, मुझे अपने बच्चे के लिए सेविंग करना है, मुझे अपने शादी, अपने घर में अपनी बहन की शादी के लिए इन्वेस्ट करना है, सेव करना है. We use it interchangeably, and that's the biggest problem. These two terms, my friends, these are very, very different terms, and it's very necessary to understand the difference between the two. Saving is basically keeping aside money, put it aside for a future goal or for a near future goal, and the requirement for that should be more in liquid in nature. I remember my grandmother, she used to save money. She used to put money, whatever she could get from, my grandfather or other household chores. And she used to save money in a box, tuck it under her bed. That was her way of saving the money. Because she was not aware that kuch emergencies aa jayenge, she could use the money. Then we became evolved and we started putting that money, that box became a bank account. We started putting money in a bank account. And that is one way of saving, because I can take out the money anytime I want and my immediate requirements could be fulfilled. But friends, sending your child for a foreign degree is not going to be fulfilled by that saving. That requires investing. So here's what investing is. Investing is putting your money to work equally harder or probably more harder than you. So you work hard every day to, earn the income, gain salary, get your business profits. But your money should be working harder than you. And that's what is investing. And you put that, and you do that through putting money in stock markets. You do that through putting money in real estate, investing in gold, mutual funds, and so on. And every channel that we talk about has its own pros and cons, basis the risk that we want to attach ourselves to, or the risk that we want to get exposure to, or you can say the time horizon that we're looking at, or the knowledge that we have about that particular channel. So our choice of choosing an investment tool depends upon all these different factors. And mutual funds somewhere sit around the comfort level amongst all these channels. And I'll explain you why. Can you go to the next slide, please? So what exactly is mutual fund? Mutual fund is a trust, it's an investment trust where people like you and me who earn money through my salaries, through our salaries or regular income, through regular income or through business, we give our money to an asset management company, okay, who invest the money in the market. And there are fund managers in that company who are professionals, who are more skilled at their jobs. They choose the companies very carefully and they put the money across equity or debt basis the philosophy of that fund, and they make money out of that investment. And then a part of that money is given back to us in the form of our income or our returns, based the number of units we would have invested in. So that's mutual fund. In very simple terms, in very simple bhasha, if I say, imagine I have to go from Bombay to Mahabaleshwar. I have two options. I can take my own car, I can drive down, and I'll reach Mahabaleshwar, provided I am aware of the routes. I know Google Map very well, and I know where those, the turns are and which cities to avoid and which roads to take. Now, imagine another scenario would be, I don't decide to drive myself. I hired a professional driver who comes with a nice car, who knows exactly where are the hills, who knows exactly where are the speed breakers, where there is a creek, where there is a plain road, and he will mold his driving accordingly. He will speed up when there is a plain road. He'll watch out when there are turns. So that is what mutual fund does. It is managed by professionals who know exactly the kind of skills who know exactly the kind of environment they're getting into, and basis their research, they spend years and years doing research on companies, identifying the prospects of their investment, and then they take the calls. And they use tools and technologies which people like us, retail investors like us, we may not even know of, or they're too costly for us to even get subscribed to. So those are the professionals who manage our money. That's about mutual fund. And what's also important to know here is mutual fund offer you a flexibility. You can choose any sum of money basis your current appetite, your current income, your horizon that you have in mind. You choose which mode you want to go for. You can invest via lump sum, which is I have some amount of money today, I put everything to together and invest. Or I feel that my income, I'm in a salary and I have a salary and I get income under regular intervals. I may not have too much of a money at my disposable in one time. So every month the money gets debited from my bank account. That's the investment. So it gives you a flexibility to invest and withdraw anytime. Of course, there are some schemes like ELSS, equity linked saving schemes, where you get tax benefit in ATC. So they have a lock-in of 3 years. Other than that, all other funds, open-ended funds, you can put the money anytime you want. You can withdraw the money anytime you want, and you'll get your investment in your bank account in the next 1 to 3 days, subject to some exit load in a few schemes. So that's advantage of mutual funds in terms of payments. Now, it's a very highly regulated industry. There's a government body called SEBI, Securities and Exchange Board of India, which mandates and which makes the policies and guidelines for all mutual fund companies to follow. And mind you, these are very, very stringent guidelines, and there are strict penalties if an asset management company flouts those rules and regulations. And these guidelines are made keeping in mind the vested interest of the investor. Okay, and very easy to reach out to them online, offline, for any concern that you have, and there are people who take actions on it. And all asset management companies are also required to take actions on those complaints. Mutual funds offer you diversification. So imagine you have 100 rupees, you have 1,000 rupees, let's say, and you want to invest. You go to an equity market, you choose stocks of your choice. With 1,000 rupees, you may not get more number of choices to make, but let's say you choose 3 or 4 stocks and you put 1 share each, you buy 1 share each of those stocks and you invest. The market, of course, in its own terms, it will go up, it will go down, and there are high chances, and your ability to make money is highly correlated or highly dependent upon the success of those stocks that you've chosen. Whereas in a mutual fund, when you put $1,000, I would have put $2,000, Neeraj would have put $5,000, and somebody else would have put their own set of money. All this money gets together and goes to a mutual fund company. They put the money in 35 to 40 stocks, where I become an owner of all the 35 to 40 stocks in my own capacity based on the amount of investment I have made. So even if one stock or one share doesn't do well, one company doesn't do well, I still have the other 39 companies to take me across. So my entire risk gets diversified and I get better exposure. Now, we also say that investment gives you higher potential returns. I say CAGR more than inflation rate. I won't say, it comes, of course, with the disclaimer. However, there are good probable chances that mutual fund investment would give you better potential return than money sitting idle in your bank account. Of course, you have different options. Basis your risk profile, basis your time horizon, you have to choose which fund you want to invest in. If you're investing for a 10-year, 15-year, 20-year period, you can very well go for an equity scheme with international exposure as well. And if you want to invest for a shorter duration, let's say for 5 years, 2 years, 3 years, or 1 year, you have to choose an appropriate scheme, more likely a debt scheme, so that your chances of getting volatile or negative returns is lower in those schemes. As I said, it again comes with a disclaimer. So basis your horizon, you can choose your scheme, and accordingly you can get your return. Now, somebody asked me which is the best fund. Now, to answer that question, it's a very simple answer. The best fund is a fund where you stay invested for a very long period of time. There can be no better fund than that. Finally, mutual funds is a very transparent mechanism. You get your statements of account every month. You get to see how much your wealth has generated, how much did you invest in the past, since inception. And even the asset management companies, they publish all their reports through fact sheets. You can go online into the asset management company's website. to see where all your money has gone or has been invested into. So if I have invested, let's say 1,000 rupees in a particular fund, I can go and check which all companies has my investment gone into. So to that level of detail and transparent way mutual funds work. And as I said, it's a low risk option because you get to diversify and you get to enjoy the goodness of many companies along with that. Can you go to the next slide, please? Now, as I said, that there are different ways of investing in mutual funds. There is a lump sum where you put aside, you take all the money that you have, give it together to your company or to your advisor, and he invests the entire sum of money. That is what we call as lump sum. SIP is a disciplined approach. SIP is when you instruct your bank to give money on a specific date to the mutual fund company, and the money will get invested in the scheme that you have chosen already. That's an SIP. Now, to explain how SIP is the best choice, I'll just tell a small story. It's a Hindu mythology story. Once upon a time, Lord Indra got very angry with farmers of a particular province, and he cursed them that for the next 12 years, there'll be no rain in this province. Farmers got very, they got upset as well, and they begged Lord Indra for mercy. Lord Indra said, okay, you go to Lord Shiva, because after 12 years, when Lord Shiva plays his damru, only then will it rain. Farmers went to Lord Shiva and he requested him, Lord Shiva, if you can please play your damru today, we'll be spared. Lord Shiva already was aware of this entire thing, and Lord Indra had told him not to oblige the farmer's request. And Lord Shiva said, no, I will play my damru only after 12 years. Farmers returned, they came back dejected, very disheartened, and they crashed in their homes. But there was one farmer who didn't lose heart, and he started to work on the field. Every morning he used to get up, he used to plow the field, put the seeds, and he used to work on the field every day. And this continued for many, many years. All other farmers got together after a few years, and I said, why are you wasting your time? You know it is not going to rain for the next 12 years. It's only been 3 years now. We still have 9 years. Why are you wasting your time? Why are you even doing the hard work? And he said, I am doing this because if I don't do it, perhaps I may forget. I may lose the discipline, or I may even forget how to do that, or I may lose my practice. Of course, others make fun of him. Lord Parvati was listening to all this conversation. She went to Lord Shiva and said, you decided to play damru after 12 years, but did you even think that what if you lose your practice? And Lord Shiva, out of his anxiety, said, I cannot lose my practice. And he started to play the damru. No sooner he played the damru, it started to rain. Every farmer was shocked because they were not prepared. It rained so much that day that their entire 3-year drought was fulfilled. But the problem was nobody was prepared to take advantage. Everybody had to work 3 times, 4 times harder that year to get some crops. Whereas the first farmer who was on a disciplined approach and he worked on the field every day, he had the super bumper crop that year. So what I'm trying to explain is it is consistency which gives you best results over a long period of time. And that's what SIP is all about. It's a disciplined investing. You don't have to worry about, do I have enough money to invest today? Because I have a goal in mind and I want to do that on a regular basis. Second is rupee cost averaging. What it means is you can get to average your total investment. Example, you have 100 rupees and the NAV of the scheme, NAV is the market price of that particular fund, is at 10 rupees. You invest 100 rupees in that and you get 10 units. 100 divided by 10 is 10 units. Next month, after a few months, the market falls. The NAV of that fund, instead of 10, becomes 8 rupees. You have your 100 rupees that goes out every month judiciously. With those 100 rupees, you actually get 100 divided by 8, 12 units. So now you have 10 plus 12, 22 units with you. Now, when the market goes up, you actually gain because you have 12 rupees. Now compare it with the scenario where you would have invested only in the beginning at a 10 rupee cost and you only had 10 rupees. But now, since you've gained more because the market fell, you have more number of units and there are more chances that you'll make more money in the future. That is called rupee cost averaging. It takes advantage from the volatility in the market. And as we all know, markets are all the time volatile. And in DSP, we have a favorite saying, we call markets fluctuate. The third is power of compounding. So all of us in our secondary, in our class 8, 9, standard, when we were there, we learned the formula of simple interest, compound interest. I wish we were more serious that time. I was not. And I never realized that the most important component in that formula is N. So if you remember, the formula for compound interest is A is equals to P, 1 plus R raised to the power N. Correct? I'm sure everybody remembers. So this N is the number of years that you are in that particular fund, or in that, invested in that particular, you invested that particular amount of money. And that is the most important factor in mutual funds, in SIPs. And how it makes an impact is because, let's say today you have 100 rupees, you've invested. First year you get a return of 10 rupees. So now you have 110 rupees. So the second year, that 110 rupees would grow for you. It's not the 100 rupees, which is the simple interest. It is the compounding effect. Whatever return you make in a particular year, that also multiplies from the next year onwards. So that's the power of compounding. SIPs makes market timing irrelevant. What it means is you can invest at any point of time, doesn't have to worry about whether the market will fall or rise, because you know that you'll be taking advantage of rupee cost when the markets are fluctuating, and you can be in a better position to make better returns. There's again a famous saying that never try to time the market, but try to maintain or try to spend more time in the market, which means you stay invested for long. Don't really worry about whether you can actually, when to get in and when to get out without having to worry about it. And SIP is the better choice, because once you started it, you really have to forget about it, and then the money goes out every month in a disciplined way. There's a famous saying by Mr. Warren Buffett, who is the most successful investor in the world as we know him. He says, do not spend what you have, do not save what you get after spending, but spend what you're left with after saving. So that's what the concept of SIP. You every month, towards the beginning of the month, I would say towards the beginning of the month, you start your SIP, let the money go in a particular scheme of your choice, the one that you have chosen very carefully for a very long period of time. And then whatever money is left, to try to feel that that is all you have as the income for that particular month, and then you spend. And lastly, better returns. Of course, as we said, there are higher chances of you getting better returns when you stay invested for a long period of time. And when you do an SIP for a long, you choose schemes where the returns are higher on an average, because you can get to participate in equity funds, you can get to participate in international funds where the risks are higher. At the same time, the risks are taken care of through diversification and by spending more time in the market. So that's about it. Stay invested, that's the first thing, and choose SIP as your preferred mode of staying investment. Yeah, over to you, Neeraj.
Thank you, Manish. That was really very insightful. Let me also introduce you all to EduFund and what are the services which we provide. The first thing which I would want to focus on is education cost calculator. This is India's first unique cost calculator, which takes into account multiple factors, which is used in ensuring that you are on the right track when you're saving for your child. Let me give you an example. Few years back, dollar versus rupee was at around 45. Currently, it's at 75. So even if the price of the university is not increasing, or the cost of education in a particular university outside India is not increasing, you are ending up paying more because of the rupee depreciation. Let's assume the fees of Harvard education would be, say, $100,000. In that, like 10 years before now, it would have been 45 lakhs, but whereas today it would be 75 lakhs. So you are ending up paying 30 lakhs more in the rupee terms, which is because of the depreciation of currency. So what we do in this education cost calculator is, we have taken components such as inflation, college specific inflation, currency depreciation, and many other factors, which provides you a more accurate estimate of what would be the cost of education when your child is going to go to the college. Right, so it's a very simple, easy to use calculator which you can download from which you can access with the help of EduFund's app. All you need to do is put in the details of your child. You will be able to use this calculator and get an estimate that how much money you need to save for your child's education in future. The calculator also shows you what kind of SIP you are supposed to do, so that you can start with the disciplined investing, as Manish mentioned, and achieve that goal. In addition to this, we also provide access to 4,000 mutual funds and also US ETF. US ETF is a very great product to help you ensure that you are geographically diversified. If you are looking to send your child abroad, it makes more sense to you have it makes more sense for you to have some portion of your investments in the dollar currency so that your currency is hedged. Additionally, we are a SEBI registered investment advisor, so we try to ensure that the parent's risk profile is reflecting in the portfolio in which he is investing, which means that we try to rebalance the portfolio at very frequent level so that the portfolio's risk is in line with the risk appetite of the parent. We provide easy access to curated portfolios. These portfolios are curated by the research team of EduFund and also the research team of some of the large AMCs. In addition to the financial planning part, we also provide you services on the education part. You get access to career counselors so that you can get help in the SOP and also understanding about the 360-degree development of your child. You get access to IELTS counseling. And in addition to that, you also get access to education loan through our partner banks. Next slide. So that's all about EduFund. We are basically a unified platform which helps you provide services which are required in the entire value chain for a parent who is saving towards his child's education. Now we are open for questions. Manish, we have a question from a participant. What is asset allocation? Would you want to take that?
Sorry, yeah, sure. So, okay, that's a wonderful question, and one of the most talked about terms when it comes to investments and comes to mutual funds. Asset allocation basically means you have multiple options to invest your money, and how well you divide your money across different kinds of assets. Which means if you are very young in your age, you're young guy, young person, you can probably take more risk because you want to invest money for a long period of time. And then at that time, you put aside more money or allocate more money towards equity schemes. As and when you grow old, or as and when the goal for which you are investing comes nearer, you have to shift, you have to make the balance, and you have to take out money from equity and probably have to put more towards debt. Because as and when you come towards your goal, or as and when you retire or get an age, you don't want your investments to be too volatile. So that's the art of managing your assets in a way that, depending upon your risks, depending upon your future goals and the time period, you allocate between the different assets, and so that you can get the maximum out of your investment.
Thank you. The next question is, what is education loan? I'll take that. So education loan is an unsecured loan, which helps you repay or which helps you pay the cost of education to the financial institution. We have partnered with banks like ICICI Bank and Axis Bank, and you'll be able to apply for education loan through our platform. Manish, there's a question, long term mein DSP mein kaun sa fund, which fund is better? Would you want to answer that?
Okay, I think I've already answered that question, that the best fund is the fund where you stay invested for a long period of time. There cannot be any other answer to this. However, if you're staying invested for a long period of time, you can go for an equity oriented fund where there is higher chances of you getting better returns. So that would be my answer. Stay invested for long. That's the only secret.
There's another question. How is EduFund different from child insurance? So child insurance is a completely different product. It's more on the risk management side, whereas EduFund helps you save for your child's education purpose. So when you are saving for something, when you are saving towards a goal, or when you are doing a goal-based investing, you are looking to increase the wealth so that you can cover the cost of that goal in a very easy manner. Whereas in the case of insurance, you are trying to basically mitigate the risk which may arise because of a certain event not happening or happening. So these are two completely different products. EduFund is more towards the child's education planning, where we try to ensure that the rising cost of education should not be a hindrance in you giving the quality education to your child. We believe that access to quality education in today's time is no more a luxury, but a necessity. So we help parents plan for that in a very early age, so that when time comes for them to send their children abroad or for higher education in India, they do not get surprised because of a very higher or heavy cost. Next question is, can IFA be a partner with you for education loan? We would request you to drop an email to our support ID and we would be able to answer that on that email. Manish, there's a question.
Yeah, please go ahead.
So Manish, there's a question. As the child's education is a very long-term goal, is it advisable to invest in a pure small cap fund only? Would you be able to take that?
Yeah. So that's a very valid, I would say, note, because because small cap is a category of fund where if you stay invested for a very long period of time, like 10 year, 15 year, 20 year, it most likely tends to give you very good returns. So I would say, yes, it can be advised. It is advisable to stay invested if you buy a small cap fund and with a longer horizon in mind, 15 years, 20 years down the line, it would be a good investment opportunity.
Next question is, what factors to consider while choosing SIP for moderate to high returns?
So the factors are very simple. Number one, you have to have a goal in mind. And when you say moderate to high returns, your goal should be a long-term goal. And as I said, for a longer term duration goal, it is advisable that you go for an equity oriented scheme, which can give you potentially higher return than any other schemes that we have. And I think EduFund also has a risk calculator or a risk profiler through which you can determine which category of risk you have. So I would suggest you would definitely do that. And then you ascertain what is the profile that you have, whether it is conservative in nature, aggressive in nature, and accordingly, they recommend some funds as well. So yeah, the factors are very simple: time duration, long-term horizon, and you can choose with these two in mind, we can choose an equity-oriented scheme.
I'll just add to that. So as Manish mentioned that we have a risk calculator. So in that risk calculator, we have actually a set of 8 to 10 questions, of which investment horizon is a part. In addition to that, we have questions like your number of dependents, your income level, what kind of expenses do you see, and what would be your behavior if market falls or corrects by, say, roughly around 20%. So this questionnaire or the risk calculator helps you give you a holistic understanding of what could be your risk appetite. We would suggest you to please download the EduFund app, go through the risk calculator and assess your risk. It will give you a very good picture on what kind of risk and asset allocation should you choose for. Next question is, can we open multiple accounts? Of course, you will be able to open multiple accounts. So you can download the EduFund app through Android or iOS platform, and you can use your mobile number and you will get an OTP. You'll be able to create your account. The process is as simple as that. Pabiha, any other questions?
No, I think so far these are the only ones.
The link to download the app is already shared on the chat box. You'll be able to download the link from you'll be able to download the app from that link. And the process of signing up is very simple. You can just put in your mobile number and you will get an OTP to create an account.
I see there's one more question. Can I open mutual fund account in name of a minor? Yeah, absolutely. It is possible in many platforms and companies, they allow that. However, there's a rule which says that the minor bank account has to be co-owned by the parent and the guardian. So because the redemption can only happen in that account, which is co-owned or a joint account. So technically, yes, it is very much possible and should definitely do that.
There's another question from Sundar Vasudev Rao, which is related to comparing the children policy with EduFund. As I said, policy or insurance policies is more on the mitigating of the risk, whereas EduFund helps parents plan for their children's education by helping them create wealth which will be required for their education purpose, which will be required for their education. We'll share the detailed note with you on your email related to IFA and also the comparison between children policy and EduFund.
If there are any other questions, please go ahead and ask right now. We've shared a small survey with you. If you can answer those questions, that will be great for us to understand and reach out to you if you need any assistance. So we don't have any other questions. Thanks a lot, Neeraj and Manish, for taking out time and sharing these insights with us. Thanks a lot, all the attendees. And for your reference, we have shared the link of the app in the chat box. Thank you, everyone.
Thank you all. Thank
Thank
you,
you,
EduFund,
Bhavya.
for
Thank you.
inviting. Bye-bye.